Welcome. I think we're going to spend the next 25 or 30 minutes or so talking about the Panoply, and then we'll ask some questions at the end. My name is Neal Gandhi. I'm the co-founder and CEO of the Panoply. And I guess what we're going to do is we're going to give you a quick overview of what we do, tell you a little about who we are as a team, what we do, who our customers are, our financials, our growth strategy, I guess what makes us different, and then close off with a summary at the end. I think the format here is that we have to allow questions at the end, so I will rattle through as quickly as I can, if that's okay. So we are a digitally native technology services company here to help our clients navigate the fourth industrial revolution. I will come and explain that in a bit more detail in a little while. We operate in a high growth market, so according to IDC, the digital transformation market in EMEA is reported to be due to be worth $82 billion a year by 2021, which is the market that we operate within. We were listed on AIM in December of last year, so we've just been on the market for 4 or 5 months. We came out at a 74p price. We were oversubscribed. Our key institutional investors are Octopus, Living Bridge, or Gresham House, as they're now called, and Rathbones. We announced our half one revenue back in December. That's the half year to September 30th, which is 10.1 million revenue, 1.9 million EBITDA, and a big growth in the number of clients. So 90 clients versus 114 clients in the 12 months previous. So significant growth in the number of clients that we have. We are profitable, cash generative, and we tend to pay a dividend after the publication of our March 2020 results. So it's exposure to high tech and yet profitable, cash generative, and dividend paying. In terms of who we are, so I'm super lucky to have found the internet at the very beginning, or the World Wide Web at the very beginning. I found myself in Silicon Valley in 1994, 1995, saw the birth of the web, came back, set up an internet consultancy here, sold that, did a managed service company, sold that, did an Indian-based agile software development company, and sold that. So done a number of exits to the tune of about 117 million pounds or thereabouts. Certainly been at the forefront of the internet for a long time now. My co-founders, Ollie here. Ollie and Jim here will be available to answer questions at the end as well. Ollie came from a background of corporate finance, helped a number of companies, was a nomad, helped a number of companies come to AIM, probably 12 or 15 by the time you were kind of 32, 33, something like that. And has subsequently been working as a CFO for a number of organizations for the last few years. And then we met in 2016. Ollie came on board in December 2016. We incorporated the company then and IPO'd in December 18, so 2 years from incorporation to the listing. Jim is the CEO of one of the companies that we brought into the group, Manifesto, but is also our Chief Innovation Officer. So, as he calls it, the gobby one, out there being the voice of the brand, presenting, doing his podcast, and basically promoting us out to the broader, wider world in all sorts of forums, everything including the logistics conference this week
on Tuesday,
where we get out and speak to any audience that wants to listen to us, really. Sarah's our Chief of Staff and by far the most sensible one of all. She provides the governance layer for all the companies that we bring into the group. The group today comprises of 8 companies, so 7 acquisitions and 1 that we home grew within the group itself. In terms of the board, our board is myself and Ollie, and then Mark Smith is our chair. Mark was CFO and COO at Chime Communications PLC. He was there from 1989 to 2015 when it was sold to private equity for £374 million. Isabel is our voice of consciousness. Isabel ran Salesforce Foundation worldwide, and that's a really important message for us, and we can talk about that in a bit. And Chris Sweetland, a fantastic non-exec director to have on board, incredible attention to detail. He was deputy CFO at WPP through its growth years, and if you've seen our admission document, where you have to disclose directorships in the last 5 years, it runs to about 200 companies. He's an incredible guy, fantastic for us to have on board, and keeps asking all the probing questions, which is exactly what you want your non-exec to do. So fantastic board, we're very pleased to have them on board. In terms of what we do, so Panoply is a digitally native technology services company here to help our clients navigate the fourth industrial revolution. But let me unpack that. What does that actually mean? So many established companies today face a number of challenges. One is that their technology is woefully out of date. And that's something that they've allowed to happen over probably decades now. And the challenge is when your technology is woefully out of date, you're unable to respond to changing customer needs. So the needs of customers that the challenger banks, for example, are responding to, established organizations find it very, very difficult to cope with that. So take e-commerce, take ASOS versus Marks & Spencer. You have a situation where ASOS is cloud native, digitally native. All the systems are built to respond to consumers as consumers want today, versus Marks & Spencer, who have a load of technology that basically doesn't do the job. So we work with established companies, established organizations, both in government, commercial, and NGOs, to help them navigate the journey from where they are to where they need to be. We advise at a strategic level, but then we also do. So we then execute. So the majority of our employees are actually software engineers. Think of us today as, if you take the technology services landscape over the last 20 or 30 years, you've seen the huge growth of the likes of Accenture, IBM Global Services, Capgemini, and any number of very large organizations that count their headcount in the hundreds of thousands, which used to be an asset. But the problem today is that software, it doesn't take that many people to write great software anymore. It actually takes a substantially smaller number of people to write that software. If you are a company that measures your headcount in hundreds of thousands, that is an existential threat. Because every time you turn up as a client partner trying to win a deal, you're trying to get hundreds of people onto the account. The reality is you need tens nowadays to be more effective, which is kind of where we step in. We split our practices into 5 areas: experience, which is service and UX design, the whole digital journey for a user, all the way through and mapping that out. XaaS, which is a term we came up with, which kind of means anything as a service, platform as a service, infrastructure as a service, talent as a service, basically services that are delivered on top of things like Google Cloud Platform or AWS or Microsoft Azure. Intelligence, which is anything from analytics and reporting and BI, right the way through to machine learning and artificial intelligence. Transformation is anything from, again, digital and strategy transformation, and managing that right the way through to program design and working with clients to work out how they go from where they are to where they want to be. So an example would be Christian Aid, which is a digital transformation program with a number of work streams where they're spending something like £10 million over the next several years to actually transform how they work and how they work with their people in the field and so on. And then finally, automation, which is things like robotic process automation, chatbots, voice interfaces, and so on and so forth. As I said at the beginning, what we are in effect is exposure to some of these advanced technologies like AI, like robotic process automation, like applied intelligence, chatbots, conversational interfaces, and so on, and yet at the same time, profitable, cash generative, and ultimately dividend paying. Our clients include major government agencies. So we work in we split our revenues or report our revenues into 3 big sectors: government, public sector, NGOs, and commercial. Our government business is growing the most rapid. So in the last reported numbers, which is the 6 months, as I said, to September last year, that grew 250%. We see substantial growth in that business today. So clients like DVLA, MHCLG, which is that one there, UK Hydrographics Office, and then right the way through to commercial organisations like News International. So some examples of the work that we do. DVLA, we're working on personalised registrations, where we're working to transform the process for how somebody goes about buying a personalised registration number for their car. Right the way through to UCL, where we're working on robotic process automation to automate a number of initially HR processes, but then other processes as well. Through to News International and News UK, where we're rewriting the Times and Sunday Times subscription services, but also their mobile, their apps that exist on the smartphone or on the tablet. So it's a series of wide-ranging engagements, but typically at the cutting edge of technology, helping clients really create the sort of services that their users really want to use. In terms of our numbers, so these aren't necessarily like for like because we did a year-end change here. So we went from the calendar year to the March year-end. So actually these are adjusted. So we went from 10.6 to 15.6 to the year ending 31st of March 19. Blaine's forecast there. is 21.1 million revenue and 3 million EBITDA. We've just put out a trading update last week saying we're in line with those numbers, so we're very confident about these numbers here. So you see big growth, revenue up 48%, EBITDA up 58% for the 6 months of September, and cash, a very strong cash position. So, and again, you'll expect to see us report those numbers at the back end of June. So good growth, so both organic and acquisitive. But our model is to grow through both organic growth and acquisitive growth. And again, I'll come and talk about that. So growth itself. So what are we looking to do, and how do we organize ourselves? So if you take the end-to-end requirement for a client, it kind of goes from strategy through to service design and UX design, through to cloud-native software development, through to machine learning and data analytics and so on, through to other interfaces like chatbots, through to cybersecurity, through to DevOps. And that's a kind of jigsaw puzzle that we're looking to fill out. So essentially what we're looking to do is acquire companies in geographies that kind of fit one of those. So we're looking for complementary companies. So you take a UK cluster, we're looking for a series of complementary companies that can work together, that are held together by values, that kind of believe in the same things that we believe in, so that you can create a fast-moving, non-bureaucratic organization that can work with clients at pace. So the thing that clients are really struggling with is their traditional providers are extremely slow in the way they operate. A friend of mine sold his company to Accenture. He now has 15 people on a bid review conference call. It takes weeks to get a bid out of the door. And when clients are looking to work in weeks, that's obviously not what they're looking for. So the way we organize ourselves is in complementary companies that are focused on working together to deliver an end-to-end solution for clients. So we have a UK cluster, we have the start of a Nordic cluster, we have one company at the moment in the Nordics, but we intend to acquire more in the Nordics over the next few months and years, and then replicate that in Germany, replicate that in Benelux, and grow in that way. So continue to replicate these geographic clusters around the world, all around Europe. We acquire using an acquisition formula. So we've acquired 7 companies to date. We use a formula for that. The formula is designed to be accretive to investors. So every time we announce an acquisition, you can be sure that it's from a dilution perspective, that's actually adds shareholder value. And it's also designed to help us execute on deals very quickly. And the way the formula works, and without getting into too much detail because there's not necessarily the time to do so, but the way the formula works is it's designed to weed out the weakest companies. We're looking for profitable, cash generative companies that do have good cash conversion straight to bottom line. And we're looking to bring them into the group, and we're looking to weed out those weaker companies through the formula, and the formula actually weeds out those companies. So when potential acquisitions see our formula, the weakest companies typically run away because they're kind of weak. It's punitive for them to go backwards, basically. And so that's a highly effective due diligence model for us. We're also in the few months and years that we've been operating, we've developed a governance model that basically splits companies into 3 different groups. So internal growth companies, like our robotic process automation company is a growth company that we've grown within the group from startup. We manage that in a certain way, along with the startups that we have. So Green Shoot Labs is one of the companies in our group that's applied artificial intelligence, focused on conversational management. We manage those in a certain way. We manage the other sort of more established companies in another way. And then we have potentially, should we have to go to special measures, we've got a governance model there as well. We also have a 100-day plan. So when we acquire a company, we know what the first 100 days looks like in terms of integrating that company in. It's very prescribed. It's defined exactly what we're going to do. And as I say, we've done 7 acquisitions. So we're getting pretty good at that. So our key differentiators. So firstly, it's collaborative. So the way we hold our companies together, firstly, is through purpose and values, which sounds very soft and fluffy, but the reality is that if you buy into our purpose and what we're here to do, and when we go and visit companies, we're assessing the organization from a values perspective. Do they buy into our values? The values at the bottom right there: entrepreneurial, creative, ego-free, and conscious. we're looking for companies that really buy into that, because if they buy into that and they wholeheartedly believe in it and they buy into our story, then they're going to be focused on collaborating. So all of our deals to date have been exclusively share deals, so nobody's taken anything off the table so far. And as a consequence of that, they know that every founder knows that their long-term wealth is tied up in the shares and the performance of the shares in the group itself. So there's full alignment with investors there. So they're collaborative to the core. They understand that we have to prove to investors, to the city, that 1 + 1 is greater than 3. And we have to show that the value of the group is actually working. And so that's kind of partly why they're collaborative. We talked about this non-bureaucratic model, what we call the starling operating model. The way to think of that is a murmuration of starlings. You've seen the videos of these birds swooping around, seemingly acting as one, yet a group of individual birds. When you think of the Panoply, that's kind of how we think of our operating model. We think of a group of individuals that are working together for the greater good, if you like, and that's the operating model that seems to have worked for us to date. It means that they're fast-moving, they're responsive, they're entrepreneurial, and they lack bureaucracy. I mean, if you think of the murmuration of starlings, there's no discernible command and control structure there. They just instinctively know what to do, and that's very much how we organise our company. We talked about being a purpose-driven public company. Our purpose, which we've refined recently, is around safeguarding the future. So we know that the work that we do could, particularly in AI, in robotic process automation, and some of the other areas of machine learning and some of the things that we're doing today, we know that we are potentially responsible for almost fracturing of society. We see technology doing that today. We want to be on the right side of history. So by looking at safeguarding the future, by working with our clients to make sure that there are adequate retraining programs in place, we see ourselves getting a massive competitive edge there. We don't see others saying that. We think others should, but we don't see others saying that. As an example of that, we said that to Blue Prism, one of our partners, a few weeks ago. We said, this is what we believe in, this is how we operate. And as a consequence of that, our robotic process automation consultancy within the group got to pitch to do the keynote at Blue Prism's EMEA sales kickoff meeting. Now, you imagine the number of partners that they have, everyone from Accenture and Deloitte and everybody else, yet it was us that got to pitch to, or do the keynote, a 50-minute keynote of their, in front of 200 of their salespeople. So we've seen already that having purpose actually gives us better sales opportunities, and that's beginning to play out. And certainly taking a responsible attitude to the work that we do has better outcomes for us as well. Talked about us being profitable and cash generative. So at a point of ambition, we were debt-free. All the acquisitions are accretive. So basically the formula stops us from overpaying for acquisitions. There's also a share price floor in terms of how we, so one of the things that some of you may be aware of is this kind of death spiral in acquisitions where the share price drops, you've done an earn-out that's based upon giving more shares, the share price falls even further, and you kind of end up in this death spiral. Some of you may be familiar with that. Our structure stops that from happening. So investors are protected in any number of ways, and that's one of them. Hugely focused growth strategy. So a dedicated M&A team in place today, where we're focused on finding the acquisitions for ourselves. We originate our own deals. So far, all of our deals have been originated by ourselves. We haven't used any brokers so far. I'm not saying that we won't ever use a broker, because we're being approached all the time nowadays by brokers with opportunities. But generally, we look at originating our own deals. By doing that, we're buying companies that are not actively on the market. It means that we don't end up having to overpay for them. But it also means that we can really cherry pick the very best companies that we want within our group. And I talked about our core values. So in summary, I think it's a burgeoning market. The market itself is growing at 16.3% compound annual growth. It's a sector that's ripe for disruption. I talked about the very large organizations, the Accentures, the Capgeminis, the IBM Global Services, Tata, Wipro, TCS. The list goes on and on and on. They're all huge. They're all bureaucratic. They've all got too many people. The way I think of it is, if you look at the 90s, That was the birth of those very large organizations today. Today, there will be, when you look back in 20 years, there'll have been a new generation. So that lot were set up for the information revolution, that kind of the IT revolution that took place from the sort of 80s, 90s onwards. Today, we're in the fourth industrial revolution, which requires a new kind of company. There will be future winners. We look at ourselves as one of those future winners. We see ourselves in 20 years as being one of those companies that you look back on and went, they were one of the winners then. Think about, and one of the things that people say to us is your services, you're not scalable. Well, if you think about Accenture, who are 400,000 people today, 25 years ago, there were 6,000 people. So if anyone ever says services isn't scalable, it just isn't the case. And what tends to happen, of course, is that when you do a good job for clients, you tend to hang around in that client for an awfully long time. So we have clients, and the numbers, if you take our half one results of the clients that we build in that half year, 41% of them were also billed in the year before and the year before that. If we flip that number around and said how many of those 2017 clients were billed in half one, the percentage would be even higher. You tend to stick around for an awfully long time. So although it's not booked repeat revenue, it is repeat revenue because it keeps on coming. We talked about our organic and acquisitive growth plan, and as I said at the beginning, it's exposure to AI and machine learning, conversational interfaces, RPA, cloud native software, a whole breadth of cutting edge technologies, and yet at the same time profitable today, cash generative today, and with an anticipated dividend after the March 20 results. And on that, I think we'll take questions.
Yeah, you're saying that you've got a model which means you don't overpay for acquisitions, and you get the right things. I mean, I'm wondering what kind of EV, EBITDA multiple that gives you, and what kind of size of acquisitions you are going for, both the ones you've done and the ones looking forwards.
Sure. So in an ideal world, we're looking for companies with between 3 and 10 million revenue, companies that are profitable, largely debt-free. We don't mind a bit of invoice discounting or something like that, but generally debt-free. And in terms of what we pay, so to date, we've historically paid between 6 and 7 times EBITDA, last 12 months historic EBITDA for those companies.
Okay, and do you cost synergies an important part of your acquisitions?
Cost synergies are not a massive part of our acquisition. So if you think about how you integrate services companies into people-centric services companies, one of the quickest ways, I've been acquired by private equity, I've been backed by VC, I've been acquired by a PLC, and I've been acquired by a NASDAQ-listed company. So I've seen every integration there is, pretty much. And one of the quickest ways you can kill a services company is by integrating HR, for example. You'll kill it in about 3 months. And so the opportunity is to increase revenues at a substantially faster rate than has historically been the norm, through collaboration, through access to bigger deals. So one of our companies in the group, when they were a 3 million revenue company, because they were part of the group, won a £9 million call-off contract from DVLA running over several years. So we've already evidenced that actually when you bring these companies together, you can get the kind of opportunities that historically weren't there. Blue Prism is another example. We're a startup in the RPA space, and yet because we're able to refer to being part of a group, they took us seriously from day one. We got to present at their EMEA sales kickoff. Even in the last few days, AWS, Amazon Web Services, the big cloud company you'll all be familiar with, AWS are treating us very differently to when there were individual companies that were in the group, and we're seeing opportunities as a consequence of that. So for us, we're after the big growth opportunity rather than trying to take out. Any of us here could take 2, 3, 4, 5 points of cost out of any company, and in doing so, we'd probably kill it. I don't know of anyone that kind of went, yay, it's a shared service center. And at the same time, I don't know of any procurement department that can buy a laptop more effectively than an entrepreneur. So I don't believe in that. What we believe in is providing a platform for greater growth.
Fine. So the acquisitions will kind of run basically independently, but obviously there's cross collaboration and cross sales between them.
There is, absolutely. And we have a really strong governance model. So they're not kind of just left alone to do whatever. We put a non-exec onto the board. Do you want to answer this one?
No.
We put a non-exec onto the board. We've got the 100-day plan. We know from a financial reporting and a governance perspective, and from a collaboration perspective, what we're looking to do. But yeah, very much. They're kind of we don't want to become a bureaucratic, slow organisation.
So there's not exactly kind of top-down management from your level. Then it's more that their own management are kind of reporting upwards.
Yeah, or reporting across. So one of the things the CEOs do is they write to each other every quarter, doing their commitment numbers, but not to us. They write to each other. They're committing to each other. It's part of the group.
Okay. And are they running their own finances, or is there a central FD who's kind of deciding, how the money should flow in the business?
So each of the businesses has their own accounting functions, which we have largely remained the same since we bought them. Some of them's been slightly bulked up actually, and then all of the information flows into our central team. We have a couple of guys in finance in the central team that aggregate the information and consolidate it basically. And then from a treasury management point of view, we run that from the centre as well.
I'm looking at the forecasts for revenue and EBITDA. So it seems to me that profitability, if you can call that profitability, is growing very modestly in the forecast when you consider that the sector you quoted is growing at 16%, and indeed you're also acquisitive. So I assume there's no acquisitions factored into that. So in reality, surely you can grow profit a bit quicker than that.
Yeah, that's a really good point. So you're absolutely right. So acquisitions aren't built into that model. They'll be announced. Obviously, the forecast will go up accordingly as they're announced. What we have is that since listing, is we have pretty large PLC-related costs. There's a board, there are governance, there's a bunch of things that are in there that are PLC-related. We don't anticipate that those costs will grow dramatically as we add more acquisitions. So what one can anticipate that actually from a trading and operating profits perspective, you'll continue to see growth. From a PLC cost perspective, that should stay relatively flat. And so that team that's in place has substantial capacity to load on further acquisitions. And so you'd expect to see that flow through in the figures as we make more acquisitions.
So as more acquisitions are made, because they're accretive, you should see these profit forecasts edge up gradually 10, 15% over time.
Probably, I wouldn't even say edge up because the PLC costs will stay flat.
Right. No, I mean relative to what's forecast at the moment for profitability, which is...
As a percentage.
Well, both the margins, but also if you look at we've got a forecast this year, you say 3 million EBITDA is pretty much in the bag. Then we've got forecast for 2020, 3.2, then going to 3.6. Those are very modest increases relative to the size of the market. So I'm guessing should you make more acquisitions, then the analysts might, or they might not. As those acquisitions come through, you'd expect to see those profit forecasts or expectations rise.
Yes, absolutely. Yeah, you would expect to see, and obviously we're very active in M&A. And you would expect to see those profits fall. The incoming profits should largely go straight to the bottom line. There are very few additional group costs associated. Maybe a bit of audit, a few bits and bobs here, but nothing massive.
So why are you more than a conglomerate?
Yeah, that's a good question. So firstly, we carefully curate the companies coming in. So we're not just buying anything. We're buying companies that fit our jigsaw puzzle. So you're looking for the collaboration opportunities every time. So if you think of that mix from strategy through service design and UX, through cloud native software and so on, as you fill in each of those blocks, it's a kind of network effect. What happens is the whole thing becomes more and more powerful because you can do the end-to-end engagement. And we're already seeing, so our cloud native software company, I talked about AWS earlier, our cloud native software company that's focuses very much on back end, strong relationship with AWS, Manifesto have had some good success with some in the not-for-profit sector on fundraising. What was it?
Donation platform for
Donation
UNICEF.
platforms for UNICEF. Yet it's something that we've not managed to get AWS to really pick on so far, and choose to promote in the not-for-profit sector, even though they're actually hugely ambitious in that sector. And yet recently, again, being part of the group, that is something that AWS are now able to pick up on. They see more relevance for them. And so we can see greater value being generated from Manifesto as a direct consequence of that, of the other company that has the relationship with AWS. So we're far more than a conglomerate as a consequence.
I think the other point is that we're not focused on buying hundreds of businesses across the UK. We're looking at buying a select group of companies and keeping it to a size where actually the principals in each business can still have relationships with those businesses within their geographic cluster. And that's really important for enabling the cross-selling to work.
Collaboration between your businesses, kind of, you're saying creating a new service or a new solution or package for people. Does that mean you have salespeople at the group level who effectively become salespeople for a new virtual company, a product that didn't exist before, or the salespeople individually attached to each of the companies?
So what we do is empower all of the sales, client-facing people in all of the companies to sell the whole group. So rather than because that whole idea of a central sales function is the start of unaccountability and the start of extra bureaucracy and the start of all the things what the world doesn't need is a mini Accenture. And what the world needs is a new model that operates in a very different way.
Can I sorry to interrupt, but a company that wants to buy your services needs an access point that relates what it needs to understand and what it needs to be sold. So somebody has to be the point. So somebody's the point that's selling cross-sectionally through a number of your businesses?
Yes. So sales principles are already defined as part of the 100-day plan. And so a client can come in at any door. And then from that point, so if the client is, if the client's UNICEF and there's an opportunity for another part of our group within UNICEF, Manifesto would very much lead that. It would very much be on Manifesto paperwork. In fact, you've just done a deal today.
Yeah.
So our Norwegian strategy consultancy has led an engagement. They had the client relationship. It's on their paper. Manifesto are effectively subbing into the Norwegian company in that particular case. So that's already defined. The intercompany margins are defined. It's all kind of set up and ready to go.
So last one. Which one of your acquisitions required the most surgery from you post-acquisition?
So we buy profitable, cash-generative companies in the main. So no, we do buy profitable, cash-generative companies.
Fast-moving place, so things change.
They do. So far, so we categorise them in two different ways, or actually three different ways. First are the multi-million-pound, dependable. They're going to deliver X profit. They're going to deliver X profit, give or take. And that's a kind of one governance layer. And then the other kind of company, and there are acquisitions in the group which fit this. So an organisation like Green Shoot Labs, early stage, much less predictable in the early days because they're conversational interfaces. It's a new market. It's a nascent market. And we operate them in a very different way. So we have a governance model, and actually Jim sits on the board at Green Shoot Labs.
But I treat it like an accelerator, really. So I meet with the founder of that business every week. So it's quite intense. And we have a very simple scorecard. So just a simple dashboard of very, very simple metrics that can easily be talked about. So we look at the value of the pipeline every week. We look at how many new things have been added to that pipeline. We look at how many pieces of marketing material have gone out and how many new meetings have happened. So it's because it's an early stage business in a sort of quite nascent technology space, and it will develop quickly. So we've developed the model to respond at that sort of pace. I think all of the established businesses that have been acquired are still operating successfully, but the governance model is such that Sarah, as Chief of Staff, oversees anyone that's performing the non-exec activities or is the non-exec herself. So at any point that the numbers or other aspects of the business fall into a difficult situation, she would be aware of that, either directly or indirectly. And then there's special measures to take a business into if it falls below a certain if the risk profile becomes too high. And then there are people like me or Sasha or James available that can step into those businesses if needed.
And in those businesses, if we were to reach special measures, we'd go back to those kind of measurements, like number of new client meetings that week, number of proposals sent out that week, value of pipeline that week, and just get really into it.
Thank you all very much.
Great, thank you.